Ultragenyx Pharmaceutical, trading under the ticker RARE, is currently sitting at $19.49 per share, marking a staggering intraday collapse of 43.02% as of early afternoon on Monday, December 29, 2025. This massive downward move of $14.71 today isn't just a market hiccup, it is a total recalibration of how investors value a company that many believed was on the verge of a massive clinical breakthrough. If you were looking at your Robinhood app or checking your Fidelity brokerage account this morning, the sight of a 40% plus drop likely felt like a glitch. But for those watching the biotech sector, this is the harsh reality of binary clinical outcomes. The expectation among many was that setrusumab would easily clear its phase 3 hurdles and provide a massive tailwind for the stock heading into the new year. The reality we are seeing on the tape right now is that the primary endpoints for the Orbit and Cosmic studies were missed. This immediate discrepancy between the hope for a new standard of care in brittle bone disease and the actual statistical failure of the trial is what created this massive price vacuum. This isn't just about one drug, it's about the cash burn and the sudden need for significant expense reductions that the company announced alongside the data. While most investors are panicking, a few are looking at the secondary endpoints of bone mineral density and wondering if the market has overreacted. But before we assume this is a simple buy the dip opportunity, we need to look at the sheer volume of institutional selling happening right now. When you look at the activity across platforms like SoFi Invest or Interactive Brokers trading today, the volume is many times the daily average, suggesting that big institutional players are hitting the exit button hard. The common belief about Ultragenyx has always been that they are the experts in rare disease, a company that knows how to navigate the FDA and pick winning candidates. But today, that belief is being challenged at its core. If a company that specializes in rare diseases can't hit the primary endpoint in a phase 3 study for its lead candidate, what does that say about the rest of the pipeline? This is the tension that is keeping the stock pinned at these multi-year lows. Many people use Schwab Intelligent Portfolios or other automated investing sites to manage their risk, but in the world of individual brokerage accounts, a move like this requires a human touch to understand if the thesis is broken or just delayed. The market expected a win that would validate the current valuation. The reality is a clinical setback that forces a total re-evaluation of the company's timeline to profitability, which was originally slated for 2027. Let's examine the specifics of the data because that's where the real story lives. The Orbit and Cosmic trials were supposed to show a reduction in fracture rates for patients with osteogenesis imperfecta. Instead, while the drug successfully increased bone mineral density, it didn't translate into fewer broken bones at a statistically significant level when compared to the placebo or existing treatments. This is a classic biotech trap, where the secondary metrics look great, but the primary metric, the one the FDA actually cares about for approval, falls short. This is exactly why self-investing in the biotech space can be so volatile. If you are using the Fidelity mobile app to trade these names, you have to be prepared for these all-or-nothing moments. The company's management expressed surprise and disappointment, which is a rare admission in a world usually filled with corporate spin. They mentioned that the placebo group in the Orbit study had an unexpectedly low fracture rate, which makes it harder to prove that the drug is doing anything better. It's a bit like trying to prove a security system works in a neighborhood where no one ever tries to break in. You might have the best system in the world, but if the control group doesn't experience the event you're trying to prevent, your statistics are going to look weak. Institutional activity today shows a massive shift. Before today, entities like Fidelity Wealth Management and various mutual funds held significant positions in RARE, betting on this exact readout. Now, as the price hits $19, we are seeing a massive transfer of shares. Some are selling to harvest losses before the end of the year, while others might be using their interactive brokers platform to build a position at what they consider a generational bottom. This is where the psychology of expectation versus reality gets interesting. The expectation was that setrusumab would be the next big revenue driver alongside Crysvita. The reality is that the company now has to go back to the drawing board, conduct deeper data analysis, and potentially wait years for another chance at approval. Meanwhile, they are burning through assets. As of late 2025, their cash position was bolstered by royalty deals, but with a net loss of $180 million in the most recent quarter, that capital won't last forever without a clear path to new revenue. This is why the mention of significant expense reductions is so critical. It's a signal to the market that management realizes they can't keep spending like they were. For those of you holding shares or watching from the sidelines, I want to hear your take. Comment below how many shares of Ultragenyx you currently hold, or if you think this 43% drop is a justified reaction to the trial failure. Does this change your view of the rare disease sector as a whole? The business model of Ultragenyx is actually quite robust outside of this one failure, which is the part of the story most people are ignoring today. They already have 4 approved products on the market: Crysvita, Dojolvi, Evkeeza, and Mepsevii. These aren't just theoretical assets, they are generating real revenue. Crysvita alone brought in over $110 million last quarter. This is a company with a real commercial footprint, not just a lab and a dream. However, the market doesn't price biotech stocks based on what they are doing today. It prices them based on the growth expected tomorrow. When the primary growth engine for 2026 and 2027 stalls, the valuation has to compress. This is why you see the stock price trading more like a distressed asset than a growth leader. If you are using Fidelity IRAs or other long-term investment accounts, you're looking at a company that still has a path to success, but it's a much longer and more winding road than it was yesterday. The company is also working on a gene therapy for Angelman syndrome and treatments for Sanfilippo syndrome. These are high-stakes programs that could still provide the reality that exceeds the now lowered market expectations. When we talk about online investing and using various investing sites, we often focus on the big names like Apple stock, Nvidia stock, or Tesla stock. Those are the giants that move the indices. But the biotech sector is where the real drama of the market happens. A company like Ultragenyx is a reminder that in the world of drug development, biology is the ultimate boss. You can have the best management team, the most expensive Fidelity trading platform, and a portfolio designed by the best advisors, but if the molecules don't perform in the human body, the stock price will eventually reflect that truth. The current price of $19.49 is a reflection of a market that has lost confidence in the immediate upside. It is the reality stage of a cycle that started with high hopes and ended with spreadsheets and statistics reality check. Let's talk about the future outlook, because that is where the opportunity for a recovery lies. The company is not giving up on setrusumab entirely. They are looking at the bone mineral density data to see if there is a subset of patients, perhaps the younger children in the COSMIC study, where the drug could still be viable. If they can convince the FDA that the bone strength metrics are a valid surrogate for fractures, there is a slim chance they could still find a regulatory path. This is the contrarian take. While the herd is selling because the primary endpoint was missed, the smart friend at the coffee shop is looking at the 20 to 30% increases in bone density and asking if the FDA might be more flexible given the total lack of other options for these patients. If the reality of a future approval emerges from the wreckage of today's failure, the stock could see a massive V-shaped recovery. However, that is a big if. Most online investment advice would tell you to wait for stability rather than catching a falling knife. Using tools like the Robinhood app to track the price is one thing, but making a high-conviction bet on a clinical recovery requires a deep understanding of the regulatory environment. There is also the possibility of a buyout. At a market cap that has just been shaved in half, Ultragenyx starts to look like an attractive target for a larger pharmaceutical company that wants to expand its rare disease portfolio. Big Pharma has plenty of capital and is always looking for established commercial teams and approved products. If a buyer looks at the $600 million plus in annual revenue and decides they can cut the R&D waste and turn this into a cash flow positive subsidiary, the current $19 price point might be seen as a steal. This is the tension between the trader who sees a 40% loss and the strategist who sees an undervalued revenue stream. Whether you are using SoFi Active Investing or an individual brokerage account, these are the scenarios you have to weigh. The risk, of course, is that the expenses